Hello, this is Blaise Fabry with China Vester again, and this is the second part of the shale oil industry analysis. This time this is the balance sheet analysis. Let me just blow up the chart that I'm going to follow. So what is basically the four stocks that we have, the same four stocks we had, and this is the debt to asset development over the last 4 years. Now, there is some significant difference between some of the stocks that you see here. Take a look at Oasis Petroleum, and then the debt to asset ratio is very low. Total liabilities versus total assets is somewhere around 25%, which is very different from Kodiak and Oasis in particular. Look at this, the breakout year 2012 for Kodiak. The company issued $750 million debt, which put its debt to asset ratio to somewhere 50%. Next year it added more debt, and now it's around 58%. Oasis, similar development. Breakout year 2012, big jump on the liabilities, and then from here an additional debt that put it into the same range, 57-58% debt to asset ratio. Continental is a little different story though, because even though it's been a fast-growing company just like everybody else did, and seems that the liabilities grew just as fast, there is some remarkable difference that the company, the total liabilities stood around $6 billion at the end of 2013, but out of this there was a big chunk is deferred income tax. As a matter of fact, this number alone is $1,262,000,000 as of today. So if we subtract that amount, 1.2 billion, the debt to asset ratio should be around here, which is in halfway in between WLLs and Oasises and Kodiaks. So in other words, if it hasn't been for the deferred income tax, then the company is really not as highly leveraged as Oasis or Kodiak. So that's the big difference between these companies. Next time we're going to study the cash flows and see that these leverage companies, how much cash they generate, because the next big question is that Kodiak and Oasis and the Continental are able to grow now organically, meaning that they generate enough cash from operations, because their ability to tap markets is really in question now that they are so highly leveraged. Thank you for watching, and come back to see our cash flow analysis.